Hey guys, it's Maynard. It's Close of Business Tuesday, and we're going to keep on with the tradition of trying to talk about the world and see what we know and what we can tell you. We've got some great guests with us here today. On the phone, Matt Portillo, our co-head of research, John Gibson, senior advisor to TPH and Energy Technology, but CEO of Flotek, Colin Fenton, our head of commodities, and Arjun Murti, a senior advisor with Warburg Pincus, longtime head of research at Goldman Sachs. Mike Bradley from our capital markets area, Jeff Tillery, head of capital markets, and Dan Pickering, CEO of Pickering Energy Partners and founder of TPH. Let's start, guys, with the government. Everybody's talking about the government. What are they going to do? What are they going to do? And you're not sure which government they're talking about. Lately, they've been talking about Texas and the Railroad Commission. Do you think we're going to see the Railroad Commission get involved here? Should they get involved? What do you think they're thinking? Could they make a difference? What do you think? Dan?
Maynard, the worse the environment gets, the more likely that there's some political solution. So in Texas, 5 million barrels a day of production. The Texas Railroad Commission could step in and create proration or ask people to slow down, force people to slow down. So I think that type of situation gets more likely, not at 25 or 35, but at 15, when you need a solution, there could be one. So I guess the odds go up, the worse things get, things are probably getting worse, so the odds are going up.
Jeff, what do you think? You think we're going to see the Railroad Commission?
I think drastic times, you see all sorts of things happen. I think there is a little bit of cross currents between, lots of different producers in that mix. We still have a fair number of wells being drilled and completed, and so I think there's a lot of cross currents in there, and it's not a real solution to anything other than potentially removing the very tip off the bottom of the trough in price.
Mike, you had a poignant comment about this earlier.
Yeah, like I would say is, letting the genie out of the bottle, that's really easy to do, but getting them back in the bottle is a lot tougher to do. Look, you're only going to have something that's going to really be 30, maybe 45, 50 days, something of that nature. So, why do something short term to mess up something on a long term basis? So, yeah.
So we did Texas. Arjun, you're a longtime geopolitical watcher. Do you think we're going to see something out of Russia, out of Saudi, out of Trump? Like, is there a global political something that's going to help, or are we just so far behind in demand that we're not going to see it?
Maynard, I think you just alluded to it. I mean, when demand is down 15, 20, 25, whatever it is, million barrels a day, I think this idea that Saudi and Russia cutting or not cutting by 1.5 million, or even raising their production by that amount, I find it to be fairly irrelevant. So people talk about this being a price war, and maybe if demand was plus or minus 1 million barrels a day, it would be. But when you're down 15 to 20 to 25, I don't think there's anything anyone can do. We're going to fill storage, or at least fill all the sources of infrastructure. I think the question is, do these kind of things matter once you force the rebalancing of supply and demand at our new lower level of demand? And that might be the time when, whether it's the TRC or OPEC or Russia, might be able to make a difference on the recovery side. I don't think they can make a difference at this current time.
Okay, so maybe that's a good transition, Dan, into what you see happening. How are we going to go through? I think everybody perceives we got to go through something really bad here in the short term. But how bad do you think it gets, and how do you think how do you manage through this?
Yeah, it's going to get bad. And it's going to play out in the next 90 days or so. Why? Because, as Arjun mentioned, we're going to fill storage. And when you do that, price essentially goes to whatever number is required to shut in production to balance supply in that manner. So absolutely gets worse before better. And, we're in an extreme scenario. We've never been in this environment before. And so companies are going to have to act decisively, I think, and dramatically. So I don't know why you spend any money right now to drill wells, because you're either not going to produce them or you're going to produce them into terrible prices. And so I think that we're in for a series of capital spending cuts, headcount cuts and reductions. We've been talking about value over volume. There is no value to volume right now. So I would say we're going to see a dramatic set of scale backs within the industry. And, my take has been, why not act quickly and significantly? Because if you're wrong and price gets better, okay, great, you missed a tiny opportunity. If you're wrong and things get worse, then you've put your company at risk.
So what do you think, Matt, you can get in here? We've seen so many reductions so far. It seems like your average E&P has cut CapEx for this year by 40 to 50%. Do you think we're going to see a second round of cuts, guys, or what's the thought there? I'll throw that to Dan and Matt.
Yeah, Maynard, I think we're going to see another step change here in CapEx going into Q2. Conversations with the upstream operators, both on the public and private side in the last week, have really evolved into potentially a necessity to essentially take a much larger frac holiday than initially envisioned in order to combat low prices. On top of that, I think you are going to see a significant reduction in capital over time as it relates to the drill bit, just given the continued depression in the forward curve. So as we're sitting today, we're modeling CapEx for 2020 down about 50%, but we could see a further drop in programs just given what's happening on regional pricing in these various different basins from the Eagle Ford all the way back to the Bakken.
And I think on last week's show, we were talking about rig count being 300 maybe by the end of the year. Is that number look optimistic now as it keeps getting worse?
No, I'd say it's probably about right. Maybe you err to the downside, but no, it's about online with what we were projecting for sure.
Okay.
Maynard, I just interject a couple things. One is, the more you spend, the weaker you are, I think, in this environment. That means you've got to take money off your balance sheet to invest it in a long-term asset in the ground because you're trying to get cash flow for a debt covenant, which to me says you're weak, not strong. So the stronger you are, the more you can cut your capital and the more you can protect your balance sheet. And I would say maybe 300 rigs running is what we're going to be at, but show me how the math works on those 300 rigs. I just don't know how those wells are making any money, so I question why they're being drilled. I'm going to question every company that spends very much money in this environment.
So, John Gibson, maybe we could draw on your oilfield service background. If the E&Ps are going to cut as much capital as possible, how, if you're managing, you are running an oilfield service company right now, but how does the oilfield service sector manage through, Dan said 90 days, but we've got a long patch of tough times ahead of us, particularly in OFS. How do you manage through in an environment like this?
John, I think you're muted.
It was a hard question. Maybe thinking it over. Let me, as John finds that mute key, Dan, I think we were all saying 3, 6, 9 months ago, when you starve the industry for capital, we all know what happens. It doesn't invest, and then you eventually get a price rally out on the horizon because demand is there, and we don't have the product. But does this just mean it's going to be that much better in a few years, or how are you thinking about investing in the space right now?
Yeah, the worse it is in the near term, the better it's going to be. We need this industry. So I think in the midst of this near-term chaos, the real issue is you're going to make a lot of money deploying capital into stressed and distressed situations that develop over the next 18 to 24 months. But you only have to believe two things. One, that we need oil and gas for our economy to work, and I think that's the case. So demand will recover to some number that's a heck of a lot higher than the 75 or 80 that we're consuming right now. It'll be 100 plus. And you've got to believe that reinvestment economics don't work at 30 or 40. So that can't be the long-term price. And I believe that. I think we'll see $50 to $70 crude when things get better. And the issue, though, is that a bunch of companies aren't going to make it through this downturn, and the assets are going to get really cheap because there's not that much capital that's brave enough to step in. And so this is not 16 where a bunch of people came in and saved the industry. This is 2020 and 2021 where a bunch of companies are going to go broke and assets are going to trade at 10 or 15 cents on the dollar. So will be the best investing opportunity since the 1980s, probably the best generational opportunity that we've seen, but it's going to get worse before we get there.
So one thing maybe, sorry, Jeff, you were going to say something?
Interject. We're clearly impacting supply side. I think to harp on one of Dan's points, we know demand will recover. I think the degree to which the recovery is exciting from an investor standpoint and an oil price standpoint is the demand recovery to 90% of where we were pre all this, 100%, 105%, and have we changed the trajectory of demand longer term or not really does influence the recovery. The supply side, I think we're all confident it's really getting damaged here.
So what's your, Arjun, you've seen a lot of these cycles, a lot of sentiment changes that go with them. Do you think we get back to, let's say, 6, 9, 12 months from now, 100 million barrels a day of demand?
How quickly? I think we'll get a big bounce in demand as the world comes out of shutdown. I think the degree to which you still have some amount of social distancing going on, how much work from home happens, global trade probably has some pressure. Those things can determine whether we get fully back to 100 or not going forward. But I think we will have a pretty big demand recovery. And the big question is going to be, once you draw down inventories, how much of the oil that is forced to be shut in, how quickly and at what cost does it come back? And I think that's going to be a big driver of how robust the recovery is on a price basis.
So, Maynard, we ought to be thinking about this in quarters and years, not months. Mm-hmm. Right? This is going to be a bottom that lasts through this year into next year and maybe to the end of next year. I mean, nothing's going to get better super fast. So, you're mainly talking about demand between now I'm talking
and
about demand,
year.
but I mean the dynamic of the damage that's being inflicted is going to take some time to absorb and recover from, both the way supply and demand acts and interacts. We're going to have a huge amount of inventory to work through before prices can really recover. And this is, we need to be thinking about this as a 2 to 5 year process, not a 2 to 5 month or 2 to 5 quarter thing. If you're thinking about a V bottom, I think it's the wrong way to think about it. If you're planning for a V bottom, you're asking to go broke, I think.
Well, maybe the way to ask the question is, what's the earliest reasonable time to see a full restoration of demand? You think it's a couple years, 18 months?
Yeah, I think it's at least through a year, into next year at some point in time. I mean, there's no way we're coming back to 100 million barrels plus in the next 2 or 3 months. I mean, you're going to, like Arjun said, you're going to have social distancing. You're going to have people just doing different things. You're going to have unemployment globally is going to be much more than it was when we went into this thing. So there's just no way we're getting back there. Honestly, I think if we get back to 95 million barrels a day, that'd be fantastic. Then you've got a market where OPEC can manage that.
In 18 months.
In 18 months? 18 months, I think you can get back to it. The next 6 months, I think it's very hard to think about that.
Okay. We're in a recession, period. And we're going to be in one for...
So, Maynard, I don't think we need to get back to 100 to get back to an upcycle. And so for a business like oil, which is so different than other commodities or really other industries, where you're limited by your physical infrastructure, once you stress it, you bounce hard off those extremes. We saw that in 08 when we went to 150 and crushed demand, and you were at 33 by the end of the year for many different reasons. Whatever low number we get to, it's not so much do we get back to 100 million barrels a day demand. It's that you will have forced a supply-demand balance at a low demand number. As demand recovers, I think you're going to have a stronger price recovery than maybe people expect. It's not to say we're going to go back to a bull market, but you're going to bounce hard off of whatever those lows are. I don't think it's a question of when do we get back to 100 million barrels a day. I agree. I think it was Mike that it could take 2, 3, maybe even 4 years. I think it's a question of really how easy is it to bring in that forced shut-in oil back. And clearly there are newer fields and better operators that can bring it back quickly, but you don't know what's going to get shut in. It's not an analysis of who's got the high-cost production. It's an analysis of who can't deliver the next barrel. and it could be anywhere. And I think those costs are going to vary. Some will bring their supply back easily, but some it might never come back, or at least not come back for a generation. I think we don't know that number, but that's going to play a big role in sort of the magnitude of rebound we have.
So those are great points, Arjun. So just a big picture, how much production at its peak gets shut in the next 3-4 months? Do you think it's
probably 10 million barrels.
10 million barrels. So 10 million barrels potentially have been shut in, and then you have potentially you've damaged that production, and at a minimum you're going to have some cost to get it going again, which is part of your point.
Well, I think, and furthermore, you're exposing just the underlying decline of the asset globally.
And I think
CapEx is seizing up everywhere, not here.
And that's a great point. I think everyone focuses on what's the U.S. shut-ins going to look like, and how are they going to come back. They're going to be global shut-ins, and a lot of those reservoirs are conventional. A lot of those countries don't have capital, and so they're not going to be coming back as people think. So back to Arjun's point, yeah, demand is going to come back to a level, but supplies, it's going to be challenged to get back to those levels, and that's what's going to drive this. And we haven't had that type of market in many, many years, and I think that attracts generalists back to the sector at some point.
Okay. So maybe, Arjun, one other question for you, which is when you think back to the late 90s, we had a ton of consolidation. We had the Asian financial crisis. We had the Economist article with $5 oil. How do you think about that period versus this one?
That's a great question. And Maynard, I think I was supposed to say this before. The views expressed are my own and not necessarily reflective of any company or organization I'm associated with. But if you go back to the 1990s, so a couple of things came out of that cycle. You had, on the one hand, the super major mergers, ExxonMobil, Chevron, Texaco, et cetera. And those were really driven by efficiency gains, cutting costs, and so forth. And it did result in improved returns on capital, improved returns to shareholders, and so forth. The other thing that came out of it, though, was a whole bunch of asset sales from those companies. So think about when BP merged with Amoco and the sale of Western Canada and those oil sands assets. That is a large chunk of what has made Canadian Natural Resources a great company over the last 20 years. The sale of Altura, ultimately to Oxy. It made Oxy in the 90s and in the 2000s and last decade as a great Permian player. And so for the independents that have retained a strong balance sheet, there's going to be a lot of interesting transition that comes out of it. I think at this point in time, I wouldn't expect to see the super major type mergers. I think when you look at the largest companies, and frankly, I think this is true across industries, it's been a 20-year trend across the S&P 500 of improved profit margins. Companies have been focused for a long time on how do I improve returns on capital, how do I keep costs low. So those types of mergers I wouldn't expect to see, but I think it's going to be a very capital-starved industry. Prior to coronavirus, this looked like 2020 looked like it was going to be the last year of sort of non-OPEC ex-shale growth that was a remnant of the $100 oil period. So Johan Sverdrup starting up in Norway, some of the Brazil fields and so forth. And the only question was, would shale finally slow? And as I think you know, Maynard, and your investors appreciate, investors were already moving out of this space because of disappointing returns on capital. The shale guys disappointed, the rest of the sector disappointed. You had concerns about climate and ESG, and I don't think those concerns are going away. So you were already going to have sort of a forced capital discipline on the shale producers that was likely going to result in slowing shale growth. Now we've got $20 oil and possibly lower prices. Whatever lack of capital we had before is obviously exacerbated. So coming out of this cycle, we think it's going to be pretty tight on the supply side. And for those that have capital, the largest companies for sure, some of the independents that retain strong balance sheets, and certainly private enterprise, some of the private capital out there, it's going to be, I think Dan said, this a generational investment opportunity. My career goes back 30 years. And if you look at all the prior crises, Asian financial crisis, tech bubble burst, the 08-09 great financial crisis, I think this investment opportunity is kind of as exciting, is going to be as interesting and exciting as any that we've had in the energy sector, certainly in my 30-year career.
Awesome. Colin Fenton, you're on. We've asked Colin each week to give us one slide, one thought, one thing he was watching this week. So Colin, let me call on you.
Sure, thanks, Maynard. This week we're going to take a look at the demand side, and it feeds into a lot of what we were just talking about. What you're looking at here on the left are daily airline cancellations by region, and you can see the sharp uptick from March 8th and then a peak around March 25th and then scaling back. And so the key message here is unplanned disruptions to flight operations are settling down, but notice that word unplanned. What you're really seeing there on the right-hand side of that chart is a bit of an optical illusion. The drop-off reflects fewer schedulings to be canceled. And so there's an idea here of skimming along the bottom. And on that peak day of March 25th, when there were 23,000 plus flight cancellations, we estimate foregone jet fuel demand was over 6 million barrels per that day, 6.15 to be specific. That's a 77% drop in global jet fuel demand. And now, even at these numbers that we're seeing in the last couple of days, we're talking about 4.5 million barrels per day for as long as we stay around this low level of activity of foregone jet fuel demand. And to put a finer point on it, if you look at all those flight cancellations in the month of March, that shock in just 1 month is nearly 4 times larger than the average annual number of U.S. commercial flight cancellations over the past 5 years. So it's just a jaw-dropping number like all the others that we've been talking about. And then the right-hand side of the chart are jet fuel prices, and you can see there the same kind of decline that we've seen in other markets. What we wanted to emphasize is looking across Chicago, Los Angeles, New York Harbor, Rotterdam, Singapore, and the U.S. Gulf Coast, so truly a global perspective, we've begun to see at least some testing of support and a bounce off a very, very low level, 56 cents per gallon. Now, I wouldn't get too bulled up about this. Dan's points are spot on, but it's just to frame precisely where we are in the moment that at the minimum, we're beginning to see some of the peak demand losses begin to flow through the market. And now the question is the duration as we come out on the other side. But I would still be in the camp of saying that we're going to have at least a 3 million barrel per day average hit to demand globally over the course of this year. And looking at the supply and demand balance to, throw my 2 cents on one of the questions we had earlier, we probably need to see a 5 million barrel per day cut, actual cut to 2019 production smoothed out over 2021. Back to you, Maynard.
So, Colin, the airlines, they're not flying, don't need our product, and we got too much product. Are we going to see some interesting partnerships in here between producers and consumers as both sides try to navigate through the fact that demand has dropped off so much?
Yeah, I mean, that's a great question. What's been really interesting for me, just looking at it analytically, is how much data has come out from companies like OpenTable, where you're seeing on their website a very interesting presentation of data that's flowing through their system. It basically shows 100% cut down in online reservations, and yet you're beginning to see these entrepreneurial kind of arrangements of getting food from restaurants to consumers. And so that is actually helping some of the diesel and gasoline components as we go more to this bring the product to the customer in their shelter in place. We've also seen a couple of refineries shut down in South Africa and Newfoundland, which is something that we talked about last week and have expected that you would begin to expect that numbers this large in certain basis markets just overwhelm some of the local infrastructure. So we may very well see that along the supply chain, there's some interesting entrepreneurial opportunities that do not necessarily have to involve the end use consumer, like somebody in their home, but perhaps, in air quotes, a new form of the midstream.
Maynard,
yeah.
One point to that topic, I think we are very early in the sort of economic impacts of all this. And so my guess is that as unemployment and various industries, the ripple effects of shut-ins and being isolated, not shutting in production, that there is going to be protect yourself kind of thing that emerges. You asked about partnerships between consumers and producers. I mean, why? Because industry A is going to be worried about themselves. Industry B is worried about themselves. Industry C is worried about themselves. I don't think the U.S. energy industry is too worried about, protecting the consumer right now. They're worried about protecting themselves. And so I think that where that partnership starts to develop is later in this process, where everybody's sort of figured out, am I going to be alive or not? And what do I need to do to prosper? So it'll take a while.
One question for you, Dan, as an investor. I think in this last couple of years, everybody's been focused on whether they got it right or not. People have been focused on doing thoughtful mergers where it made sense, whatever that formula was. As this goes farther, are we going to start seeing more things where, it's not a perfect story, but the balance sheet works and it's a more viable entity, and investors say, thank you for doing that? And is the tension going to go down around the story because people are so focused on the balance sheets? Are we going to see those kinds of mergers, and will investors embrace them?
If something is better, doesn't have to be good, it needs to be better. So the answer is, I think investors embrace whatever makes the final entity or the surviving entity better. Doesn't have to be good, because I don't think anything is going to be good for a while. But if patient A and patient B can turn into a stronger patient C, then probably investors are going to be fine with that, because they'll worry about good down the road.
Well, in upstream, that would the classic question would be, can I leave my basin?
Absolutely. I think throw out the playbook from the last 5 years, because the playbook for the next 5 quarters is getting through the next 5 quarters and having a company. You can always deconsolidate after you consolidate. You can always step out of the basin, become a better company, not necessarily good, but better, and then become good later. So yes, you can step out of the basin. Yes, you can go from oil to gas or gas to oil, whatever is better and gets you down the road, I think, because a lot of guys aren't going to make it down that road.
John Gibson, did you find that mute key?
I did.
Oh, hot dog. Well, we've got two questions for you. One is just, you were a CEO of Landmark and a president at Halliburton. You're now CEO at Flowtech. How does an oilfield service company, big picture, how do you make it through the environment that we just described for the upstream customers?
Well, you first hire a psychiatrist to do counseling. Big picture. They need a psychiatrist where you can go to counseling every day, Maynard. It's, the difference between having spent the first 12 years at Chevron Gulf, during downturns, you still have cash flow because you have wells producing product. But in an OFS company, when you have a downturn, you basically have nothing but, debt service and depreciation and salaries. And so I think it's a really difficult time for the oilfield service sector because they're carrying a lot of cost that's hard to eject and then maintain your ability to come back. And so people are trying with furloughs. We're seeing pretty substantial layoffs, anywhere from 15 to 50% already. We're seeing pretty dramatic reductions in executive salaries. I think it's a very tough time as an oilfield service company, particularly in North America. A little better globally, but other OPEC nations are suffering right now as a result of this as well. If you're in Angola or Nigeria, it's a tough time also. So, and as an OFS company in all of those locations, when they stop working, you basically stop having any cash flow. So we're all cutting costs. We're trying to reduce our capital budgets, reducing our head counts, reducing salaries. And we believe whoever can make it till mid-2021 wins the war.
So maybe one thing, John, I know that we're going to end on a real positive note. We've heard a number of positive things already. You had to listen closely. But one thing you've been doing with Flowtech that I'd just love for you to tell the story, and then I'll invite others. Everybody tell the one thing they've noticed in this crisis that makes them particularly optimistic. But John, will you tell the world here what you've been doing to help people at Flowtech? I think it's a great story.
Well, first you have to know that Flowtech is a specialty chemical company, and so we blend chemicals, and we do it in the best possible way. We've got stainless tanks. We have pristine environments to mix chemicals. We produce complex nanofluids and enhance production from reservoirs. Well, the same equipment can be used for other purposes. And when you've got a morale issue in a company and you've got a crisis, global crisis, you often sit and ask, is there anything that we could do that would make a difference in the crisis? And so as a result, one of the ideas that we came up with is that we could actually make hand sanitizer. Isopropyl alcohol is the primary component. We have the other glycerin mixes and others, and the FDA published the guidelines and the formula for doing an acceptable formulation for hand sanitizer. So we converted a 12,000-gallon stainless steel tank to do hand sanitizer that was appropriate for hospitals and first responders, and we're making our first 12,000-gallon run this week. You know, normally you would run small batches, but I have the tendency to do things in too big a way. It's going to cost us somewhere between $4 and $6 a gallon to prepare this, and we were very fortunate to get the quality alcohol that we need, not just tech alcohol, but appropriate FDA certified alcohol. And we'll mix up 12,000 gallons in 5,000-gallon containers, and we have a large, homeless shelter organization that believes they need 1,000 gallons. So we're sort of focusing on that tier of needs that where they don't necessarily get the highest attention, but they have high interaction with people and a lot of close contact. And we're looking at nursing homes and first responders, and it looks as though we're going to use up all 12,000 gallons, Maynard. And I'm very thankful to PPH who came in and sponsored that with us, and we're getting a lot of excitement about it. And I'm now, believe it or not, I'm thinking about running a second batch. And but it's really hard to come by the appropriate components now. Alcohol's in short supply, along with masks and other things. The chemicals you need for some of these mixes are hard to get. But we're excited to have 12,000 gallons, and we're going to send some to Midland. I was on the phone talking to someone that we had the mayor of Midland involved, and we're looking at some of the hospitals and first responders as West Texas gears up for the same issues that we see here in Houston and other cities in the U.S. And so we hope we can make a small contribution by taking the capabilities and the competencies that we have and applying them and making those available. And at this point, for free. We're just doing this as a contribution to the communities we work in, and we hope it plays some small part in helping.
Well, it's a great story, and if you're watching this video and if you'd like to, if you know a place that could really use some hand sanitizer, just shoot me an email. Or if you would like to donate, we will pool the funds and get them to John, and he'll make more. So as we wrap up, guys, just around the horn, I'll start on the phone. Matt Portillo, what is your most interesting data point that gives you cause for optimism as we stare at all this right now?
Yeah, man, Eric, I think it's two things. One, just client connections have really accelerated over the last month. Investors are really engaged in the sector, and I think that's ultimately going to lead to a potentially very interesting recovery, as Arjun mentioned. And two, I think there's line of sight to an industry response here from the majors and upstream operators as it relates to supply that ultimately over the next 12 to 24 months is going to create a healthier macro backdrop. So there's really a confluence of things that are coming together that ultimately might make this a really interesting time to invest. But as Dan mentioned, it's kind of hunker down mode for the near term.
Okay, Colin?
Yeah, I think it's ingenuity. And you just heard John say that they received some pretty important information by consulting the internet. And that's something that we've heard a lot from producers and consumers, from clients and from friends, that the connectivity that's coming from the internet and technologies that we have today is changing this story in the present. And even, that phrase, flattening the curve, you have enough people who are aware of data, how to get data, how to talk to each other, that in real time, you are really seeing people change the future for the better. And I agree with Dan that this is going to take, perhaps longer than people would like it to on the physical side of things. But with that kind of positive attitude, I think we can go pretty far.
Awesome. Arjun?
Maynard, as painful as the downturn is for industry, it's an industry that's always been capable of generating competitive returns on capital. It didn't do that over the last 5 to 10 years, but I think this downturn is going to clean up some of the excess capacity, and coming out of it, you're going to have a sector where returns on capital are back to double-digit levels. You're going to get some free cash flow and capital returns, and it's actually going to be a healthier sector going forward. I'd say on a personal basis, we live here in the New York, New Jersey area, which has been particularly hard hit. And I will tell you, the one good that will come out of all this tragedy is the fact that there's a niceness that's actually come back. You can actually walk on the street and say hello to people, which is not commonly done in this area. So I will end on that optimistic human note.
That's awesome. Mike?
Yeah, I'd kind of echo those guys. I think the sentiment and energy has been so bad for so long. Commodity traders are pushing this thing as far as they can go, but I do see some optimism. Like Arjun said, I do think there's a lot of capital is coming out of the system. I do think people now are starting to think about the the next 3 months, but what's the next 2 years hold. And I sense that there's some real optimism that people are finally saying, you know what, I don't have to worry about this OPEC overhang, the spare capacity issue. I want to get involved. Not ready to get involved in the next 30 or 40 days, but sitting there going, at some point here, we're probably in the 7th or 8th inning of this pain. I'm looking to do something.
Do you think we're going to be a more appreciated industry after all this? I know that's a little touchy-feely, but I don't think any of us felt too much love from the world.
I think that's really going to be determined in the next 12 to 18 months how this industry reacts. If they throw more capital at it, the banks continue to let them borrow, which I don't think is going to happen, then the answer is no. But that's not going to be there, so they're going to be good stewards.
Jeff?
Yeah, I think for as painful as it is, what you've heard it from Arjun and Dan, just a generational opportunity. I think the sector on the other side of this is just we end up a lot more sustainable, not in the ESG sense, but in terms of forced capital discipline, higher returns. The industry construct ends up more attractive on the other side of this.
Dan, we'll end with you.
The data point that I'm most excited about is the folks who have not been involved and therefore haven't been burned are asking questions and thinking about how to invest. The unsinged fingers are starting to get excited about doing something, not right now, but over time. And so I'm enthusiastic. The best data point is that there will be some folks that step in here and deploy capital, and they're going to make a lot of money.
Awesome. Let's end on this. John Gibson, keep up the great work, and to everybody who participated, thank you. Please be safe out there, and we'll see you next week.